Hi, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, a series of short videos exploring the mechanics of cost accounting. Today's video is about unadjusted and adjusted cost of goods sold. And if you are like most people who have taken financial accounting, you probably thought there was only one type of cost of goods sold. But to the cost accountant, there are two, and the difference is incredibly important. So what we look at today is actually going to serve as the foundation for a number of the big challenges we will have and a number of the opportunities we will have to isolate margins for different products and to identify inefficiencies. Okay, unadjusted and adjusted cost of goods sold. What we're going to do with this video is we're going to pick up where we left off on the last video about applying overhead. I've already written down the assumptions that we have in our simple little glove business here. For this month, we project $100,000 of overhead, and we have an activity base of 5,000 direct labor hours. So that's our overhead driver. And if we divide the projected overhead by our activity base, we end up with $20 of overhead for every direct labor hour. So that's what we're going to use as our very simple rule to apply overhead by taking it out of the manufacturing overhead account and putting it into the account for particular jobs. And recall that we have two jobs. Job A has 4,000 hours, and job B has 2,000 hours of direct labor. So we're going to add one more. You can see I've added one more little thing here, which is that we've got $15 of direct labor wage. So right, when you think about it, if you are a product manager, if you are going to use an hour of labor, you've got to pay your worker some money. $15 is what I'm assuming, and you owe some money to headquarters, to the company itself, for all the overhead that they provided you with. So you'd better earn at least $35 in revenue for every hour of labor that you put into your contract. Otherwise, you're going to have a negative reported margin. You've got to cover both the direct labor and the overhead cost associated with that direct labor. Let's go through the entries, and I'm going to do these all in thousands to keep it as simple as possible, except for these particular rates. So let's say that the very first thing we do is that we pay our workers, and I should mention we're doing summary entries again. So we're doing just the entries that you would make, adding them up in each account over the course of the period. So what about our cash account here? Well, the first thing that I want to account for is our direct cost here of $15 per so $15 per hour that we have to pay to the worker. And so that's going to be, since we have a total of 6,000 here, 6,000 hours at $15 an hour, that's going to be 90,000 total of cash, and I'm assuming we're paying our workers in cash because I've used up the liability section. And where am I going to put that? You know, I'm going to put that directly, because these are direct costs. I know which job they're from. 4,000 hours worth is, so that's 60,000 is going to go into job A, whereas job B is going to get 30. Okay, so those are the direct costs, right? Notice that I used up $90,000 of cash, and I know exactly which cost object, which contract or job those dollars go into. Now, I also, by assumption, we have an actual $90,000 of overhead, and so we've got to take those dollars, another $90,000, but we're going to treat these differently because this is overhead. This is the rent and the utilities and the managerial supervisory salaries, everything that is associated with production, but that can't immediately and directly be identified as being incurred for a particular job. So I'm going to make this a mighty big account because I've got to write a bunch of stuff here. First, I want to remind you that the left side is the amount that we incur, right? So here, this 90 is going to go there because we incurred 90,000 of overhead. We put it on the left side of the manufacturing overhead account, and now we are in suspense because we are waiting to get the information we need to figure out how to apply that to our jobs. So when we apply it, we're counting up these hours, and we've got 4,000 at 20, which is $80,000, and that's going into job A. And we've got, right, so that's equal to 80,000. And then we have our 2,000 at 20, and that's 40,000. And that's going to go into job B. Okay, so now we've really just repeated what we did before, but this is usually pretty good to see again at this point in the material. And I want to point something out to you. Well, actually, here's what. Well, now let's do the part we haven't done, which is that we finish job A. Okay, we finish job A and we sell it. So we're going to create a finished goods account, and we're going to take the $140,000 that was in the job A account. We're going to zero that out because it's not in process anymore, and we're going to put it into finished goods. And then we're going to put, since we sold this job, we're going to take this 140 out here, and let's put it in cost of goods sold. And let's also assume that we sold half of job B. Okay, and so we're going to take 70 to get the work in process in B out. Okay, so it's now been finished, but we only sold half of it so far, so I'm only going to take 35 out of finished goods and put that into cost of goods sold. Okay, so where are we now? We now actually have our unadjusted cost of goods sold number. All this number is the sum of the reported costs of everything we sold. What do I mean by reported costs? I mean all the costs that were applied either directly or indirectly to our jobs, okay, and then made their way from work in process through finished goods all the way to cost of goods sold. So our unadjusted cost of goods sold, again, it is just for, we take each particular thing that we sold, we identify its reported cost, and we add them up. And that gets us $175,000. Why do I call it unadjusted? It's because we're not quite done. We've got one last step to undertake before we can be comfortable with our financial statements at the end of the period. And the reason is that if I look at our manufacturing overhead account, we've incurred 90, and we've applied 120. So here we have an account that is sitting on our balance sheet, and it has a credit balance. Okay, so what is this? Let's imagine, right? So it's it's particularly odd that it's sitting in the asset portion of our Queen's Cross instead of the liabilities when it has a credit balance. Maybe it's a contra asset. But I'll tell you one thing, it certainly isn't. It is not a liability. We don't owe anyone anything. If you think about the definition of a liability, it is a claim on our assets or future assets. And this manufacturing overhead account just isn't that. It's simply an estimation error. We thought that we would incur 100,000, but we only incurred 90. So we didn't put as much on the left as we thought we would. We thought that we would have activity of 5,000 direct labor hours, and that would give us 100,000 on the right, but we actually had 6,000 labor hours, so we put 120 on the right. So we have two estimation errors that both make the right side of this account bigger than the left side. It's just estimation error. It is not a liability. I could have switched this around and maybe instead of the expected 100,000, maybe we could have had 110,000 incurred, and maybe instead of 5,000 hours, we have only 4,000 hours, and then we'd have a debit balance. The left would be bigger than the right. Okay? But we don't have an asset. There's nothing in this account that has probable future economic benefit. It's not inventory you can hold in your hand. Again, it's just an estimation error. So we cannot compile our financial statements and report anything until we zero this account out. So there are two parts to zeroing this account out, right? The first is to make whatever entry it takes to make this account have a zero balance. The debits equal the credits. In this case, that's going to be a debit of 30 to make these equal. But now we have to find the other side of this entry. What we are going to do in this course, and what businesses generally do, is they take they make the complete adjustment for this 30 to cost of goods sold. So we debit for 30, and just going back to remind you about the seesaw teeter-totter, right? We have too many debits here. We've got to credit it there. We've got to balance the seesaw with a credit. So I'm going to put that adjustment here. And now our Queen's Cross balances, and we have a new number for our adjusted cost of goods sold. Here's the adjustment. The adjusted cost of goods sold is only 145,000. Okay, so what happened? The first thing is, let's get some terminology in here. In this case, we have over-applied overhead because we applied more than we incurred. We have over-applied overhead. If it had gone the other way, if the left side was bigger than the right side, then we would have under-applied overhead. If anyone starts talking about over-applied underhead, then they're either confused or have had one too many. That term does not exist. It's either over-applied overhead or under-applied overhead. In this case, right, our estimation errors caused us to apply more than we incurred, which means that we put too many dollars, right? We applied too many dollars to our contracts. And, eventually, actually, most of that has already made its way into cost of goods sold. There's a little left over, in finished goods, right? We still have, if you add this account up, you can see that we've got $35,000 still sitting in there because we haven't sold half of job B. But in this course, we make the complete adjustment to cost of goods sold. We don't try to say, oh, well, we're going to adjust the other inventory accounts as well a little bit. Now, mathematically, that used to be something that was really hard. Now, in the computer age, that's easy. But from a managerial perspective, that's very difficult. Since these are videos on mechanics, I'm not going to belabor this point, but let me just ask you to place yourself in the position of a product manager who has gone out and negotiated a price for job A under the assumption that overhead would cost you $20 an hour. And then if at the end of the year someone came to you and said, you know, I know we told you it'd be $20 an hour, but actually, because we didn't get as much other business as we thought we would, we've had to make this adjusting entry. Your effective rate is now $30 an hour, and your job has a negative margin. You're not going to be very happy. Excuse me. So, let me summarize here. The key point of this video is that there are two types of cost of goods sold. First, we have our unadjusted cost of goods sold, which is simply the sum of the reported cost of every item that we sold. And those reported costs are based on the predetermined overhead rate, in this case of $20 a direct labor hour, which in turn is based on our projections of 100,000 overhead dollars and an activity base of 5,000 direct labor hours. We know when we walk into it that projections are never actually, they never come out exactly the way we thought. So we know there's going to be some error in that estimate. But instead of adjusting essentially retroactively the costs that are applied to each individual job, what we do is we make one big adjustment, in this case reducing cost of goods sold for $30,000 to get adjusted cost of goods sold of $145, because we adjusted it's called closing out. We closed out the manufacturing overhead account to give it a zero balance and made whatever entry we had to make to cost of goods sold to balance that entry. Just a quick indication of things to come. This adjustment is going to be a big deal for us. When we get into the challenges of accounting for fixed costs, this adjustment is going to be a problem. It's going to do surprising things to our income, and it's going to be very difficult for the beginning cost accountant to keep track of and to get an intuition for. As we get later into the course, we're going to find that we can use this adjustment as a very powerful tool to highlight deviations from our original projections and get them onto the income statement as soon as possible, where they have much more impact on managers, right? Everyone's looking at the income statement, and if you were responsible for a $1 cost of goods sold increasing adjustment, you just cost your company $1, and trust me, people are going to notice that. So that's where we're headed for now. I just want you to remember the difference between the unadjusted and adjusted cost of goods sold. I hope you found this enlightening, and take a look at the other videos. Thanks a lot. Bye-bye.